I think two things are pressing on the stock market. First, I think really is the idea that even like today, the sell-off really began in earnest when Treasury Secretary Mnuchin played down the chances of fiscal stimulus before the election. I think that we've already reacted to it 2 or 3 times, but every time we get the headline, the market has to react to it again. But secondly, I think to your point about earnings, well, you're right that generally earnings have been holding up. The problem is that the banks, a couple of banks today like Wells Fargo, reported a big drop in profits. And the larger banks have been putting less aside for reserves for problems down the road than many people anticipated. And so I think that is just encouraging some risk-off profit taking. So here's what happened is on last Thursday and Friday, the U.S. stock market, like the S&P 500, gapped higher. That is, it traded above the previous day's range. Did Thursday, Friday, and it also did it on Monday. 3 days in a row, gap higher openings. And this is a sign really of a market that's like too strong, that's overextended. And so I had been anticipating a pullback, and we hadn't gotten it really until yesterday and now today. And what I think we need to do is go back and technically fill in those gaps. Just like nature abhors a vacuum, so do the markets. The markets want to fill in these gaps in price action and sort of acts, it acts like a bit like a magnet drawing prices. And so I think that's really what we're in the middle of now is a technical correction. But I think the underlying trend is still higher, and the real reason I think it's higher is the effect of lower interest rates. Not only do low interest rates make other assets less attractive, like bonds, but also low interest rates also is sort of the is multiplier effect, or discounting points for corporate earnings. Low interest rates is another positive thing for corporate balance sheets. The election itself is not a big concern right now. I think the way it's being expressed is not so much in the direction of the market, but in the volatility. And I think people who are like the professionals are really looking at that volatility, the difference between, say, October volatility and November volatility. But I think that I think you're right that all the polls and the betting markets all show the so-called blue wave. For me, I think that the key thing to keep in mind, though, is that the U.S. elite have very similar views, even though many people might not like President Trump's style, on foreign policy issues. For example, whether it's North Korea, whether it's the Iranians, whether it is the confrontation with China, I think that the U.S. elite have a common view on the substance of foreign policy, even if there might be some disagreement on how it's really expressed. So I would expect there to be a lot of continuity between a Biden government and a Trump second term in terms of foreign policy. In macro policy, of course, the Federal Reserve is an independent central bank, and they have indicated they'll keep interest rates low for a long time. That is not going to change by who's in the White House. Fiscal policy, as we were talking about, fiscal policy will be expanded, whether Trump gets reelected or the Democrats get their blue sweep. I think we're looking at fiscal stimulus, and the issue is the size of the package, or packages, and sort of the priorities. Excuse me. The IMF announced this week its new World Economic Outlook with GDP forecasts. And what they've done is they've revised upwards this year's contraction. That is, this year's contraction in the U.S. is smaller than they initially expected. But they also shaved next year's growth. And I think that the interesting thing is at what cost next year's growth. And so the U.S. doesn't look like it'll be the fastest growing, say, in the G7. But it does look like the U.S. will have the largest budget deficit. Yes, so I think that the RMB strengthens because Chinese officials allow it to strengthen. And I think that the underlying reason why there is pressure, upward pressure on the currency, is really, it's a good story, I think, for China. Part of the Phase 1 trade agreement was about these quantitative measures of how much China is going to buy from the U.S. And that's what, of course, what a lot of the U.S. talking heads focus on. But there's another part of the agreement, And the other part of the agreement focused on market opening measures. And China has been enacting these, and it's attracting foreign capital. So from a purely investor's point of view, leaving aside politics, what I see is an economy, China's economy, perhaps the only one in the G20 to grow this year. One. Secondly, what are investors hungry for in a world in which we have $16 trillion of negative yielding bonds? China offers over 3% on a 10-year bond. Thirdly, because China has taken these market liberalization measures, market opening measures, making the market more accessible to foreign investors, both to come in as well as to get out, as well as to hedge. We're seeing a foreign interest buying Chinese bonds and stocks. And I think this is a good thing for China. I think it's a good thing for the world, integrating China into the world capital markets. And this I think, stands in like almost a contradiction or in opposition with this decoupling we're seeing on trade. This week, the EU put tariffs on some parts of Chinese aluminum exports. We're seeing, of course, tensions with the U.S. continue on different parts of trade, as well as on these apps and national security issues. So I think that the integration of China's capital market is important and is bullish for the RMB. I don't know about that 650 level. That seems a bit of a stretch for me, but I do think that the RMB, when the PBOC lifted or reduced to zero the reserve requirements for forward positions last weekend, many people thought this was China again protesting the currency's strength. But I see it as a bit differently. I would say that the protest, if it is a protest, is quite mild, and I judge that by the recent fixings of the currency. And I think that if China wanted to, they could really stop the currency from appreciating. But I think in the current environment, appreciating the currency, allowing the currency to appreciate consistent with these macroeconomic forces, is going to encourage more foreign investment into China. It shows that China has matured. The policy making has matured, say, over the last few years. And so I would expect the dollar to finish the year closer to 665 against the RMB. Yeah, so I sort of think that this is really what I like about the foreign exchange market. $6.6 trillion a day average daily turnover. That means in 1 week, the foreign exchange market sees enough to cover world trade in a year. I think those capital flows are so much bigger than who sits in the U.S. White House. I think that what drives the currencies is not about personalities, but it's about policies. And I think that, in a nutshell, I put it like this, that because the U.S. runs a large trade deficit and a large budget deficit, it needs to import world savings. And in order to attract these world savings, it's got to have a higher interest rate. But because of our economy, it doesn't have a high interest rate, not a sufficiently high interest rate. And so in this automobile that we're driving, what's going to absorb the shocks? The shock absorber is the currency markets. And that means the dollar will likely have to weaken in order to make it more attractive at these interest rates to fund the U.S. current account deficit. So I've got the dollar falling broadly. And this is one of the things, of course, behind the RMB strength is partly RMB positive developments, but it's partly a bearish view on the U.S. dollar.